In this week's video, we'll review the latest charts to help us answer the question, do the facts support gloom and doom or higher highs in stocks? This is the look of the S&P 500's 30, 40, and 50-week moving averages in 1973. This is what we call a full-bore bearish look, with blue the fastest moving average on the bottom and the slopes of all three moving averages are negative. After we could see this and measure it in 1973, bad things continued to happen in the stock market. The peak to trough loss in the S&P 500 was just over 48%. Similar situation late in calendar year 2000. We have the full-bore bearish look here, with blue the fastest moving average on the bottom and the slopes of all three moving averages are down. After that, really bad things continued to happen in the stock market, with the peak to trough loss totaling over 49% in the S&P 500 index. Early in calendar year 2008, we can see the full-bore bearish look, with blue the fastest moving average on the bottom here, and the slopes of all three moving averages have rolled over. Once again, after the full-bore bearish look was in place, bad things continued to happen, with the peak to trough loss in the S&P 500 reaching almost 57% between the high that occurred in October of 2007 and the low that occurred in early March of calendar year 2009. Therefore, in the present day, do we have a concerning and similar full-bore bearish look that's formed while the stock market has been moving sideways for the most part for over a year now? The answer is no. In fact, in the present day, we have almost the polar opposite, with the S&P 500's 30, 40, and 50-week moving averages recapturing a full-bore bullish look on Friday, July 12, 2019, with blue the fastest moving average on top, and the slopes of all three moving averages have regained a positive slope. This is what a sustainable bullish trend looks like, and this is what a sustainable bearish trend looks like. Looking simply at facts in front of us in the present day, we've already established 2019 really doesn't look anything like this, really doesn't look anything like this, and really doesn't look anything like this. Another question that can help us better assess the probability of good things happening in the present day relative to the probability of bad things happening in the present day is the following. Did the S&P 500 ever regain a full-bore bullish look during the 1973-74, 2000 to 2002, or 2007 to 2009 bear market? The answer is no in all three cases. Once we moved to a full-bore bearish look, we never regained a full-bore bullish look, never regained a full-bore bullish look. Remember, full-bore bullish requires blue, the fastest moving average, to be on top, and the slopes of all three moving averages to be positive. We don't have that anywhere in this area here, nor do we have that anywhere in this area here. Contrast that with the full-bore bullish look that we just reestablished in July of 2019. If the present day really doesn't look like any of those devastating periods in history, how does this look compared to more constructive periods in history? These are the same three weekly moving averages on March 1st, 1995. It's pretty fair to say this look here is very, very similar to the look in the present day. Blue, the fastest moving average, has moved back on top, and the slopes of all three moving averages are now positive. This is another form of hard and observable evidence tying the present day case into this favorable period here between 1994 and 1995. We already know the present day case really doesn't look like the major top forming here, nor does it really look anything like the major top forming here. In fact, the present day looks a lot more like the major bottom that formed between late 2002 and the spring of 2003. Once again, full bore bullish look here in 2003, similar to the turn that we just experienced in 2019. Everything that we just said about the 2002 and 2003 case, for the most part, applies to the 2009 case. Rather than looking like the peaking process that took place in 2007 and 2008, the present day looks a lot more like the major bottom that formed in calendar year 2009. Often when we cover these cases here, we may get the question, but what about 1987? If we compare the exact same moving averages in 1987 and 1988 to the present day, it's very, very difficult to say that this look here inside of this box looks similar to this look here, where the moving averages rolled over hard and we had a full-bore bearish look. Another logical question: how many times since 1949 has blue dropped below both green and red and then regained the full-bore bullish look? And maybe more importantly, what happened next in the stock market? Dating back to 1949, there were 23 cases where the S&P 500's weekly chart regained that full-bore bullish look, and this is what happened next in the stock market. The first 30 to 120 calendar days after regaining the full-bore bullish look historically tells us to keep an open mind about volatility, even in the context of potential bullish outcomes. 30 days out, only 56% of the 23 cases were positive. 60 days out, only 65% of the cases were positive. Jumps up to 74% 90 days out and 78% 120 days out, reminding us the importance of understanding normal volatility within the context of an existing uptrend. In the historical cases, typically patience in this area here was rewarded in this area here, looking at 180 days to 5 calendar years. Investors that were able to look the other way during volatility in this area here were typically rewarded 1 year out, with 91% of the 23 cases posting positive returns, and for the most part, that's really 96%, because this case didn't pose a lot of risk 1 year out. It was at basically break even. Worst case scenario was a loss of 2.2% 1 year after regaining a full-bore bullish look on the weekly chart of the S&P 500. We know 2019 is a unique year and it will follow a unique path. All of this just simply helps us keep an open mind about better than expected outcomes looking out 1 to 5 years. The median S&P 500 gain between 2 and 5 years, 19.5%, 31%, 45%, and 58%. Clients and regular viewers may remember we covered the global Dow in the June 14th video and pointed out that there were numerous developments on the chart that told us to keep an open mind about better than expected long-term outcomes. Since covering this slide in mid-June, something else has happened on the chart of the global Dow that's noteworthy. At the end of June, the global Dow's monthly exponential 8-month moving average recaptured the exponential 9-month moving average. This is a zoomed-in look of those two moving averages on July 18th, 2019. The Bullish Cross was in the history books on June 30th. We only have data going back to 2002, but it's still helpful to ask, how many times have we seen a similar bullish cross and what happened next in both the global Dow and S&P 500. These are the 5 dates where the global Dow experienced a similar bullish cross to the one that occurred on June 30th, 2019. And this is the performance of the global Dow in those historical cases. 1 year out, 80% of the cases were positive, with a median return of 16.4%. 2 years out, those numbers go to 25.34 and 80%. 5 years from the date of the bullish cross, 100% of the cases were positive, with the median gain in the global Dow coming in at just under 45%. How did the S&P 500 perform relative to the historical cases where the global Dow was able to experience or print this bullish cross here? The S&P 500 also tended to perform very, very well 2 years out from that bullish cross. In the global Dow, the S&P 500's median return was just a little bit over 26%, with every single case posting higher numbers 2 years from the date of the cross. On a relative basis, somewhat of a mixed bag in the early days between the S&P 500 and the global Dow. The longer we moved out, the greater the advantage for the S&P 500 relative to the global Dow. Median returns in the S&P 500 were quite a bit more attractive looking out 3, 4, and 5 years. As of the close on Thursday, July 18th, the S&P 500's monthly chart still had the MACD bullish cross that we covered in last week's video. And as a reminder, in this bear market and in this devastating bear market, never had a cross similar to the one that's trying to occur in the month of July 2019. And we know from last week's video that similar monthly MACD crosses in the past, dating back to the late 1940s, produced extremely satisfying returns in the S&P 500, 180 days out all the way to 5 years out. All 7 cases produced positive returns in the S&P 500 index, with the average gain 1 year out being over 20%, 2 years out over 40%, 3 years that number jumps over 50%, then 63%, then 92%, 5 years out. Once again, simply telling us to keep an open mind about much better than expected outcomes in the years ahead. If this bullish cross goes into the history books on July 31st, 2019, and that's to be determined, it might be helpful to know in the 7 historical cases, drawdowns from the date of the cross were fairly muted. Thus, if the MACD bullish cross on the monthly chart of the S&P 500 is in place on July 31st, 2019, this will give us a reference point to understand if we're drifting from these historical cases. Given everything we know today, even if the bullish cross is not nailed down at the end of July, the odds are still favorable that we would see it in either August or September. But that is all to be determined. Let's review some more facts. No opinions, no forecasting here. Is the major peak in the S&P 500 2000-2001, major peak in the S&P 500 2007-2008. In both cases, the orange 100-day moving average in the S&P 500 crossed over the green 300-day moving average. How do the exact same moving averages look today? Instead of getting a bearish cross, we recently had a bullish cross. Very, very difficult to say this looks like this or this. Also noteworthy, on a relative basis, the present day looks more like the major bottom that came in 2003 and the major bottom that came in 2009. In both cases, the orange 100-day moving average was able to recapture the green 300-day moving average, which is similar to this look here. As we've covered in the past, dating back to 1949, once again, every single historical case was positive 2 years out, with an average gain of 27% and a median gain of 22%. This table comes from a short takes post in June of 2019. Anything else? Factually, no opinions, no forecasting. We can see this. This is July 17th, 2019. This is the S&P 500 index relative to a 30-year Treasury bond, the price of the bond. So stocks versus bonds quarterly, 1985 to 2019. We have a period from the mid-1980s into the late 1990s where stocks dominated relative to bonds. You can make an argument this ratio needed to consolidate its gains. It went sideways for a long period of time and recently experienced a bullish breakout above this level, and this level. And you can make an argument that this is somewhat of the psychological profile associated with a bullish inverse head and shoulders pattern. Similar situation here, but in this case we're looking at the Vanguard 500 fund relative to the Vanguard long-term Treasury fund. Think SPY relative to ticker symbol TLT in the ETF world. On this chart, you can make an argument that this is a bullish breakout. This is a retest, and so far we're holding above this level and above these levels here. This chart also is representative of the psychological profile for an inverse head and shoulders pattern, with this being the left shoulder, this being the head, and this being a shallow right shoulder relative to the left shoulder. Right now, this is still a constructive look, with the ratio well above an upward sloping 50-month moving average. Gold is getting a lot of attention these days. Let's talk a little bit about gold relative to the S&P 500. This is physical gold relative to the S&P 500 dating back to 1989. This is a quarterly chart with quarterly MACD that helps us with momentum. You can see here, quarterly MACD gets a bullish cross on September 30th, 1999. We also just experienced a bullish cross on the quarterly chart on June 30th, 2019. You can see after this cross here, for the most part, gold significantly outperformed stocks. However, this cross came on September 30th, 1999. If we look at that same date on a weekly chart, the ratio also experienced a bullish breakout above this downward sloping trend line. For the most part, for the next 12 months, from September 30th, 1999 to September 5th of the year 2000, the S&P 500 significantly outperformed gold. Stocks gained almost 18%, gold lost just over 7%. But it's also important for us to understand what happened from September 5th of the year 2000 going forward. The answer is a chart that unequivocally tells us that we always have to consider adding gold to a diversified portfolio. Why? We really can't afford to ignore any asset that could significantly outperform the S&P 500 over basically an 11-year period. From September 5th of the year 2000 to August 25th of 2011, physical gold gained 579% at this peak here. Over the same period, the S&P 500 lost 23%, telling us to keep an open mind about the possibility of adding gold to our portfolios sometime over the next 12 months. This is the chart we started with. This is the quarterly bullish cross that occurred on September 30th, 1999. We have a similar cross in the present day. but it took almost a year for gold to get back to that same level when we look at the gold stock ratio here. Gold underperformed and then started significantly outperforming. Notice on the weekly chart, MACD for the most part is below the zero line here. Not the case here. Weekly MACD is now staying above the zero line for a long period of time. This is the type of look that we would like to see in the present day. The longer weekly MACD black can stay above the zero line, the better. On July 17th, 2019, the same weekly MACD for the gold S&P 500 ratio is basically hovering right around the zero line. However, we have somewhat of a sleepy look here in weekly MACD for the ratio going back roughly 5 years to 2014. If we look back 10 years, we have more volatility in momentum back here, and this is a more positive look. So this is the look of weekly MACD for the gold S&P 500 ratio looking back 10 years from the present day. Somewhat of a similar look had we looked backwards from September 30th, 1999. 5 years back, somewhat of a sleepy look in here, closer to the zero line. If we go 10 years back, we get that more volatile look that we have on the present day chart. All of this simply tells us, A, we don't necessarily want to jump the gun with gold because we could be significantly disappointed in the short run. But we have enough hard evidence in front of us, evidence that we just covered, telling us that we should be very, very open to adding gold to our portfolios on short notice. Our game plan would be to add gold on a very, very small stake and see what happens going forward. If it does well, we're happy to add to it. This is the move here that we really don't want to miss, especially this move here if it were to occur again in the future. The monthly chart can help us assess the probabilities as well. This is physical gold relative to the S&P 500. This is 1990. This is the 50-month moving average for the ratio in blue. It's pretty easy to make the argument that the look of the ratio in the present day, so this rally here underneath a downward sloping 50-month, could be similar to this spike and rally here underneath a downward sloping 50-month moving average. This is why we don't want to jump the gun. Had we jumped the gun here from roughly early 1995 into roughly the year 2000, we would have been very, very disappointed with the relative performance of gold compared to the stock market. This is the period here where gold starts to annihilate the S&P 500. You can see most of it occurs after A, price has moved above the 50-month moving average, and B, the 50-month moving average has turned up. We don't have that yet in the present day. This looks more like this relative to this. If this morphs into something more like this, we will definitely become more interested in gold. We can also learn something by looking at monthly MACD for the same ratio. Notice when the ratio failed miserably here and gold was a big disappointment, monthly MACD was unable to create a sustained push above the zero line here. It was rejected. The ratio was rejected. We're still below the zero line on the monthly chart. We would prefer to see this look here morph into a more constructive look here. We pretty much know with 100% certainty if gold is going to annihilate the stock market as it did here, the 50-month moving average most likely will eventually turn up, the ratio will move above the 50-month moving average, and monthly MACD will move from below the center line to above the center line. Contrast the look in the present day and the look here with the look inside of this green box. Inside of the green box, price is pretty much always above an upward sloping 50-month moving average. The slope turns up and for the most part stays up. And inside of this green box here, for the most part, monthly MACD for the ratio stays above 0. We may get that in the present day, we just don't have it yet. Let's quickly revisit our bull-bear roadmaps that we started covering in January of this year. It's very, very difficult to say that the look of the moving average cluster and the look of price in the present day is discernibly different from the bullish looks that we were looking for and now have in the present day. We have price above moving averages that are all constructive relative to their slopes. We've had some consolidation near the moving averages, and on July 18th, we're above all of the moving averages. Like everything else that we've covered thus far, this simply helps us assess the probability of good things happening relative to the probability of bad things happening. We saw a little bit more volatility in the stock market this week, not really seeing any reaction or concern in the credit markets. Credit spreads basically unchanged from a week ago and significantly lower relative to where they were on June 5th of this year. More importantly, the present day spread really doesn't look anything like these concerning levels here that we've covered in the past. As we've noted numerous times, some type of spike, negative spike, in the area of employment would be concerning. Didn't really get that this week. Weekly jobless claims were up a little bit, but the data still points to strong labor market conditions. And the 4-week moving average, which is a little bit more relevant to what we're trying to accomplish here, was basically flat. It fell a little bit. No major red flags in this area as of July 18th. What we really like to do from a confidence perspective is find something that just happened in the present day and then understand historically what that might mean going forward. This line here shows the percent of S&P 500 stocks above their 200-day moving average. The chart is dated July 16th, 2019. On that date, the percentage of S&P 500 stocks above their 200-day moving average moved back to 75.8% after dropping all the way down to 10.8% in late December 2018. How rare is this type of move? Majorly oversold, and then back to a constructive reading? And what happened in those historical cases? If we take a broader look here, we only have data going back to 2004, but it's really only occurred 3 previous times where we moved below the green line, below 20%, and then we're able to move all the way back to 75.8% or above. So this move below doesn't count because we didn't get back to this level here. This does count because we were able to get back to the blue line. We moved below the green line, back to the blue line here. Below, this doesn't count because we didn't get back to this level. This does, and we come back here. So this point, and this point are similar to something that just occurred in July of 2019. Let's look at these 3 cases and see what we can learn. The first instance occurs in July of 2009. Ironically, the first case occurred on July 16th, 2009, making it very similar to July 16th, 2019. Here's the S&P 500 on July 16th, 2009. What happened next? The answer is really good things happened for a long period of time, with the S&P 500 tacking on an additional 205% from this point here. This move here is similar to this move here. This is February of 2012. Here's the S&P 500 in February of 2012. After seeing something here that's very, very rare and similar to what we just experienced in July of 2019, really good things happened in the stock market looking out several years with a gain of over 100%. The recent move that we've experienced from here to here is very, very similar to this move from here to here. This is 2016 here, specifically April 26th, 2016. Here's the S&P 500 in April of 2016. What happened next after a long-term period of consolidation and a sharp rally off of a high-stress low here in February of 2016? The answer is the S&P 500 broke above previous resistance and tacked on an additional 37.35%, simply telling us to keep an open mind about better than expected outcomes after something extremely rare like this happens. We understand that's a very small sample size case that we just reviewed. If that concerns you, you can pause your video player and read this here. When we're testing a hypothesis, it's important to do so from both perspectives. We've just shown that the present day really doesn't look anything like these concerning periods on our screen. And the present day does have a connection with constructive periods historically. And as we know, the only way any of this can work properly is if we head into next week and every week with that flexible, unbiased, and open mind. It may also be worth a visit to the new website to see the FAQs. We've got new and expanded FAQs covering traditional investing, low-cost passive investing, and the online/robo strategies that are currently in vogue. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.